Hey everyone, welcome back to Corporate Decoder, the place where we decode the most complex financial documents to tell you what is really going on behind the numbers. Today we're diving into K2 Capital Acquisition Corporation's latest filing, and let me tell you there is a lot going on with this one. You might think it is just another SPAC filing, but there are some really interesting details hidden in here about their strategy, their leadership, and most importantly, their financials. Before we start, if you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these filings in more detail. Join us there. So, this filing is an amendment to K2 Capital Acquisition Corporation's registration statement. Think of it as an update, an important one, because it means they're making changes to their plans or providing new information to potential investors. The date here is the 22nd of January 2026, so this information is pretty fresh. The key thing to understand is that this is an amendment. Specifically, it is amendment number 5 to their Form S-1. This means they've already filed 4 previous amendments. Each amendment usually adds or clarifies information, often in response to feedback from the seat or to update details about their offering or business plans. The company is called K2 Capital Acquisition Corporation. As the name suggests, is a special purpose acquisition company, or SPAC. SPACs are essentially shell companies that go public with the sole purpose of raising money to acquire another company. They don't have any real business operations of their own before the acquisition. They are offering 10 million units in this offering, with each unit priced at $10. That looks like a pretty standard SPAC offering, aiming to raise $100 million before accounting for expenses and any extra shares sold. Now, what is super important about SPACs like K2 Capital is their goal. They are a blank check company, meaning they haven't picked a target business yet. Their entire mission is to find a company to merge with, and they have a limited time to do it. Let's break down what you actually get when you buy a unit. Each unit has one Class A ordinary share and one right. This right is kind of like a bonus ticket. If the company successfully merges with another business, that right will let you get a fraction of an ordinary share. It is a way to give investors a bit more upside if the deal goes through. This part is crucial for any investor interested in a SPAC. It talks about redemption rights. This means if you own shares, you have the option to get your initial investment back in cash when the company merges with another business. This acts as a safety net for investors. If the merger doesn't look good, you can redeem your shares. And here is the deadline. SPACs have a ticking clock. K2 Capital has 18 months from when they close this offering to find and complete a merger. If they don't, they typically have to return the money to investors. Before this offering, no one could buy or sell their shares on the stock market because they weren't publicly traded. They plan to list on the Nasdaq under the ticker symbol K2. This is a big step marking their entry into the public markets. They're also classifying themselves as an emerging growth company and a smaller reporting company. This means they get to follow some less strict rules for public companies, like having fewer reporting requirements. This can make it easier for them to operate, but it also means investors might get a bit less information than they would from a more established company. The basic math here is simple. They're selling units for $10 each. The underwriters who help sell these shares are getting $0.05 per unit. That is their fee. So after the underwriters take their cut, K2 Capital expects to receive $9.95 for each unit sold. Not bad, but remember, a big chunk of this money is going straight into that trust account we talked about. This is the critical trust account detail. A massive $100 million or even $115 million if they sell more shares than planned is going into a trust. This money is essentially set aside and can only be used for the acquisition or to return to investors if the deal falls through. This is standard SPAC practice to protect investors. Now, let's talk about the founders and the sponsor. They bought their shares called founder shares for practically nothing, just $25,000 for nearly 5 million shares. That is about half a penny a share. This is a huge contrast to the $10 a unit that public investors are paying. This section highlights a key point for SPACs. Founder shares often convert into regular shares, but with special rules. Here their shares convert 1-to-1, but there is an anti-dilution clause. This means if the company issues more shares later, the founders might get more shares to keep their overall ownership percentage at around 28% of the company after the deal. This is important because it can significantly dilute public investors. The sponsor, K2 Capital Sponsor LLC, is controlled by Karan Thakur, who is the CEO and chairman. This is a good place to start understanding who is really in charge and making the decisions. The sponsor is also buying private placement units, which are similar to the units sold to the public, but with some key differences, like no redemption rights, meaning they're committed. They're putting in over $2.4 million for these. This table really shows the deal for the private placement investors. For every $10 they invest, they they get more units and a lot more founder shares compared to public investors. This is a way to incentivize these early private investors, but it clearly shows how much more favorable the terms are for them, and it highlights the potential dilution for public shareholders. This is where things get juicy, the dilution table. This shows how much less value an investor might get compared to what they paid, especially if many shareholders decide to redeem their shares. In the scenario where the maximum number of shares are redeemed, and the underwriters don't buy extra shares, the dilution to public shareholders is a staggering $9.72 per S-share. This means if you buy a unit for $10, almost all of that value compared to your initial investment is gone due to dilution by the time of the business combination. This is a massive hit. Before the offering, the company actually had a deficit in net tangible book value. That means their liabilities were higher than their tangible assets. This is typical for a shell company that has spent money on setup, but hasn't acquired any revenue generating assets yet. After all the costs of the offering, they expect to have over $101 million in proceeds. And as we saw, $100 million of that is going directly into the trust account. This is the money that is protected for investors. Just to operate, they've spent over $76,000 on general and administrative expenses. This is for things like legal fees, accounting, and running the company before they even find a target. They are upfront about the risks. They are a new company, no history, no revenue. So investors are really betting on the management team's ability to find and successfully merge with a good company. They also warn that past success doesn't guarantee future results. This is a standard disclaimer, but it is a good reminder that even experienced teams can face challenges. Here is another key risk. They explain that public shareholders might not always get a vote on the final deal. This means the company could proceed with a merger even if many public investors aren't happy about it. This reduces investor control. This highlights a problem for SPACs. If too many investors want their money back through redemption, the company might not have enough cash to seal the deal. This can derail potential mergers. This is a really important risk to understand. The money in the trust account is supposed to be safe for investors, but they admit that if third parties sue the company, those funds could be used to pay off claims. This means imagine you redeem your shares expecting $10 back, but due to legal claims, maybe you only get $9.5. It is rare, but it is a possibility. Scroller Sponsor will agree that it will be liable to us if and to the extent any claims by a third party. Per Candela reduced the amount of funds in the trust account to below $10 per public share, or to the actual amount per public share held in the trust account as of the date of the liquidation of the trust account, if less than $10. Per share due to reductions in the value of the trust assets. Per Candela, they do have a sponsor indemnity clause. This means the sponsor agrees to cover certain claims that might reduce the trust account below $10 per S-share. However, they also admit they haven't verified if the sponsor has enough money to actually do this, which weakens the protection quite a bit. D. Borrow Capital LLC is the lead underwriter. They are the main players organizing this whole deal. The underwriters have an option to buy an extra 1.5 million units. This is common and usually means they think the offering will be popular and they want to have extra shares to sell to meet demand. Here is the financial table analysis. After all the offering expenses, they expect to have about $101.4 million. Out of that, $100 million goes into the trust account, just as we saw earlier. This confirms the investor protection fund. The direct costs like legal and printing fees are estimated around $489,300. This is money spent just to get the offering done. Looking at their shareholder equity, it is actually in deficit $51,015. This means their liabilities are greater than their assets right now before they even get the offering money. This is normal for a pre-IPO SPAC. They have a net loss of over $76,000. This is the cost of setting up the company and preparing for this offering. They haven't generated any revenue yet, so losses are expected. This shows how many founder shares were issued to the sponsor. Almost 5 million shares for a tiny cash outlay. Their net loss here is $76,015, which aligns with the overall expenses we saw earlier. It is the cost of preparing for this IPO. This note confirms the founder shares. The sponsor put in $25,000 and got nearly 5 million shares in return. That is a massive ownership stake for a nominal investment. Again, confirming the sponsor is buying private units for $2.4 million. Once they're publicly traded, they'll start paying their sponsor $21,000 a month for office space and services. This is a pretty significant ongoing expense. The legal teams involved are big names. Loeb and Loeb are handling legal matters for the units and rights, providing credibility to the deal. With an independent accounting firm has indeed audited their initial financial statements. This is a requirement for public filings and adds a layer of verification. We're looking at their balance sheet. As expected for a pre-IPO company, it is mostly about cash and expenses. Note the shareholder deficit, meaning liabilities exceed assets, which is typical before raising significant capital. Their net loss for the period ending the 30th of September 2025 was over $76,000. This shows the expenses involved in setting up the SPAC. This again confirms the 4.9 million founder shares issued for a tiny amount. This matches the net loss figure, showing those administrative costs are the primary driver of their expenses. Their loss for the initial period after incorporation was around $21,000. These are the costs incurred right at the beginning. Now here is my take on K2 Capital Acquisition Corporation's filing. This is a classic SPAC looking to make a splash in the physical AI and advanced energy sectors, specifically SMRAs. Their strategy relies heavily on their management team's experience, which seems solid with backgrounds in finance and deal. Making the biggest story here, as with most SPACs, is the potential dilution from those founder shares and the sponsor's private placement. They bought in at pennies on the dollar, and even with anti-dilution clauses. Public investors are going to be looking at a significant drop in their investment's value relative to the founders if the deal happens. The trust account is there as a backstop for public shareholders, which is good, but the risk remains that they might not find a deal within the 18-month timeframe, forcing a liquidation. The company also faces risks related to global instability and potential regulatory hurdles, especially if they acquire a company in the AI space. Ultimately, K2 Capital seems to be following the playbook, but investors need to be very aware of the dilution and the tight deadline. Alright, that is our breakdown of K2 Capital's latest filing. What is your take on these numbers? The management team and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. And don't forget to check out our Discord in the description for more in-depth discussions. Thanks for watching. See you next time.